Hello, hi, this is Devansh Lakhani, Chartered Accountant and Angel Investor and Director of Lakhani Financial Services. Uh, so it's glad to be back on YouTube Live, and this is something really interesting that we've started a couple of weeks back, and it's good to be back, on YouTube with a completely different set of audience, and would love to really connect with people who are going to watch this YouTube. Would really like to help you guys in whatever capacity that we can, and hopefully this video, this live helps you in whatever best capacity that it could. So let's start with this topic. We've chosen this topic for the day, which is debt the new equity, right? I don't know how many of you guys would have read, today's news where the venture capital funding for Q1 FY20, current year, 25, that is 12, sorry, for current year 24, that is Jan to March 2024, has seen a dip of about 21 to 25%, from probably $3.7 billion to $2.8 billion in this quarter, vis-a-vis the similar quarter, that is Jan to March 2023. So venture capital equity funding has seen a dip in this particular quarter versus the same quarter in the last financial year, in the last calendar year, and that is a sign where probably equity markets are a little bit tight. Equity markets are taking a little bit more time in terms of closures of deals. Funds are sitting on a lot of dry powder, that we understand by talking to multiple VCs, that they have a lot of dry powder, but they're taking their own sweet time in terms of investing in startups, right? In early stage or in late stage startups, and hence, even we as an investment bank started offering a lot of debt funding solutions, and in fact, we have already raised funds for at least five startups by way of debt in the last 2 to 3 months, and continue to do so with our current new more 1 to 2 deals going on, right? And hence this topic also, why is debt the new equity, right? So debt funding, let's start with a couple of first topics, right? So the first one is like debt financing has been an old age practice. Like you guys would be aware that जब भी हम मतलब गांव से, it's starting from the rural, from rural villages, that when you are when there is a small person who's looking for a small, like who's running a small business in a village, right, and he needs some working capital loan, he goes to the the what do you call, the financier of that village, right, that mukhya or the person with the most amount of money, that मुझे interest पे loan दे दो, right, मुझे interest पे पैसा दे दो to run my business, to run the show. That is something which has been happening from those days. तो तब से लेके आज तक इंटरेस्ट पे लोन मिलता है इन टर्म्स ऑफ बिजनेस. Yes, there has been a huge amount of decentralization that has happened in terms of unsecured business loans, in terms of secured business loans. A lot of technology coming into the picture, educated people coming into the picture, and really streamlining the operation, streamlining the method of disbursing the loan, the method of collecting the loan, right? Where the chances of that account going NP are really less because of risk, diligence methods, basically, thorough due diligence method, thorough checking of the books of accounts, etc. These things have really helped, this ecosystem of financing, businesses. This has really helped in terms of how a business can avail finance, that is debt finance, at a good interest rate to really grow the business, to really help the growth of the working capital, for that matter, right? To improve the working capital, or to buy a to buy a new asset, for that matter, to buy a new plant or a machinery, right? So that is something which is really, that has been taking place since like decades, and it has, मतलब गांव से हो रहा है, rural areas में भी हो रहा है, cities में भी हो रहा है, right? There have always been financiers who have financed at an interest rate to your business, right? So it's not new when people are saying that equity is going down, debt is picking up. It is just a cyclical thing that is happening in India currently, and the reason for it to happen is that equity funds are a little bit difficult to raise right now. It is drying up, right? We'll come to that particular part also, right? Why uh, equity funds have become little difficult in terms of raising. Before that, let's go to the fact that how equity funding has taken prominence. Let's understand a little bit about equity funding from where it has come, right? It has come from the year early 2000s, or you can call it late 90s, when there was a complete dematerialization of shares, and inward remittance of foreign currency and foreign investment had increased drastically, right? When in 1991, the then finance minister, Dr. Manmohan Singh, introduced liberalization, for foreign companies to come into India and to invest in the private sector, this had opened up huge floodgates. Then in the late 90s, early 2000s, dematerialization of shares kind of happened, right? Which means that your shares need not be in a physical paper form. They can be dematerialized in a demat account in a unit manner, right? In a unit manner. In that particular manner, this really took shape, that because of such easy formation or easy operations of shares, and a lot of foreign funds coming into the picture, or a lot of foreign funds coming in India, in Indian stocks, in Indian companies, private companies, right? People really started appreciating the kind of equity investment which was coming, because that could bring a lot of skin in the game. Let's say if a foreign investor is investing in an Indian company in the year 2000, buying a 25% stake, they bring so much of expertise. A massive company from US investing in India, they bring so much expertise from the US market. They bring access to capital, they bring access to network, right? If that company wants to expand in US, they have a really good partner. That is how the equity investment started. When Coke got introduced in India in 1992, 93, right? When Pepsi came to India, when McDonald's came to India, right? Domino's came to India in 98, 99, or 2000, I'm not too sure. But when in those years, this was the time of liberalization. When they entered India, they started purchasing equity in different companies, right? Because they could not directly start operations in India without knowing the Indian market. So, what was the best way? The best way was to purchase a stake in an Indian existing company in a similar field, and to help that company grow and become a big company. And today, you see McDonald's, I mean, one of the fastest growing and the largest markets in the world for McDonald's. Domino's, Subway, you name it. I'm just naming all these food brands because that's what's coming to my mind, but you name it, right? Any brand, you take a bank, Standard Chartered Bank, an HDFC Bank, whatever, HSBC Bank, right? These all banks have become so big. Again, they all are foreign banks. They've just invested in India, taken a stake, or purchased a stake in a company, and that is how they're rolling, right? So equity has been since 2000. It got more prominence in 2000. It was there even before, but it got more prominence in 2000. Whereas debt is much older than that also, right? Now, how did private equity take prominence? Okay, so what happened is in this mid 2000s, etc., venture capital funds through private equity funds started coming to the picture, who were backed again by global investors, right? These private equity funds had to their mandate was to invest in private companies, which are massively growable companies, right? Which are growing very fast, right? So when you are investing in such companies, it becomes a great mechanism to explore the journey of that company from 10 to 100. 1 to 10 तो हो गया, अभी 10 पे that private equity or VC fund is investing. Now that time is to make it 10 to 100 before they liquidate the stake and go for an IPO, right? Where retail investors like you and me come into the picture. But what is happening that they are going on that, on the 10 to 100 ka journey, this private equity fund started investing. They were backed by LPs, most LPs being like ultra rich, family offices, funds from the US, funds from Singapore, etc. because capital was, people wanted to invest in India. It was a fast growing company and it is still a fast growing country. Sorry, people do want to invest in India, and they wanted to invest in India back then in 2000 and 2005, when venture capital funds, private equity funds, these all kind of people, they started taking a lot of prominence and a lot of assurity that yes, they will end up making money, they will end up making a strong positive return, which they did. Right, many of these funds have got an exit, they've got tremendous returns of 50, 55%, 60% plus. Right, so these all things have really happened and they've taken a good cognizance in India. Right, and it is going to still further take a, a bigger shape or a better shape. Right, equity funds are not going to stop, whether it's VC, whether it's family office, whether it's private equity. No, they're not going to stop. But what is happening is that equity funds in India are very much foreign dependent, are very much dependent on the USA. There's a saying, if America sneezes, right, it's a huge problem. The whole world catches cold. And right now, America is not in the best state. Yes, there has been a lot of free dollars which has been printed, but currently the interest rates are very high, inflation rates are very high in the US, which causes a certain kind of a problem in terms of, you know, that US investor to invest anywhere else because he's getting a good return in US itself. Why would he invest in India? If the interest rates are 5.5 to 6%, that means if you reduce the margin, that means he is making a good 4.5 to 5% or 4% in the US itself, risk free. Why would he invest in India taking that risk, go for that, probably 12%, 15%, or 20% kind of an IRR? So that is what is stopping the foreign investors to invest further in India for the time being. Till the time the US economy does not stable, the interest rates don't reduce, inflation rates don't reduce, and they find US unattractive compared to India, then they can start taking that risk in India, because that risk, that the risk margin should be pretty high. If I'm getting 4.5% in my own country, why would I risk putting my money at 15%? Where 15% that is gross. If after I take the dollar conversion, it will come down to probably 11, 12% when I take the dollar conversion and the exchange rate cost, etc. When in US, I was getting 0.2%. In India, that time the growth was much more better, faster. I could have waited. I could have taken that risk for 15, 16% as a risk investor, but not for just 5, 6%. I'm not going to take that extra risk. So that is what is happening with the US investors. They don't want to double down or further in the Indian funds right now, equity funds. अभी जो fund के पास already पैसा है, that the thing that is happening is that they are planning to invest into the current startups that are available, not raising any further funds. Right. So that is something which is happening currently in India. Okay. And hence, when equity has become tight, debt becomes little easier and vice versa. When you say debt, short-term capital debt, working capital finance, revenue-based financing, this becomes little bit on a simpler path than equity, where you can get a good working capital finance from a bank, from an NBFC, from a venture debt fund, etc. Right? So that creates a good kind of an impact. Why? Because you can really, raise the funds in terms of, for your growth, for your working capital, for your inventory, to solve that problem basically. And it's important for everyone to understand as a startup that debt funding is not bad. Okay, too much debt is bad, but you need to calculate your debt to equity ratio to understand how much debt is good, how much debt is bad. So all debt is not bad. When you have a healthy ratio of debt is to equity, right, you must definitely go in for debt, because it will give you quick capital, quick access to capital at much better IRR than the equity, because cost of equity is much higher than cost of debt today. Right, and it will open up gates, it will help you to boost your revenues immediately, right, fast. जितना churn होता है वो जल्दी जल्दी revenue you will start making that kind of a money again, which is of prime importance, right? So that is something that we must be focused upon doing, right, as a startup basically. Um and I believe that every startup who's making revenue, who's making some kind of money, and who's probably having a runway or is EBITDA positive, must look at debt as an good opportunity, right? Kitna lena chahiye, that is something that we can always discuss. You must always brainstorm with your advisor, right? If you need our help, yes, we are definitely ready to help our startups. That's what we do. In fact, just in the recent last 2 to 3 months, we have raised debt funding for 4 to 5 clients already, and we're going to do for more very soon. So if you are a startup, if you're making revenues, if you're probably making good revenues, right, and probably even EBITDA positive, right, look no further than Lakhani Financial Services (LFS). We are here to help you out in terms of fundraising, in terms of whether it's debt or equity. हम लोग दोनों करते हैं, so we are more than happy to do equity also. We've done 12 equity deals till date, 13 equity deals till date, right? So we are more than happy to do equity and also look at debt as an option. So we can always combine the two and give you a good solution wherein your weighted average cost of capital gets reduced and which will be a benefit for you, right? So think through this. If you're going to watch this, my YouTube live, drop down a comment on what topic you want me to cover in my next live. If you want us to help you, drop down, your probably your question, your query, and I'm happy to get in touch with you. If you want to get in touch with us, our details are there on the profile of this of my channel. To get in touch with us, I'm happy to help you. We are happy to help you. Um, you know, and yeah. So I think that was great. This topic is really important for all businesses to understand that equity is not the only way of raising funds, though it has been a trend, Shark Tank, startup, India, etc. But look at that as a equal good opportunity, from a viewpoint of a company rather than just an individual. And if it is a favorable debt, a good debt, don't hesitate in taking it. And that's it from my side. Thank you. Thanks a lot, everyone, for coming live with me and viewing this. It means a lot. I'm going to come back again next Monday live with all of you guys on another interesting topic. Till then, have a great day ahead. Good luck to you and keep hustling, keep working hard. Thank you.